A lot of things stayed the same for the month of September 2021. In some sense, there was a sort of normalcy that was restored in this month of the year. The children were back to school and have stayed in school so far. Canadians spent about 600 million on an election that changed pretty much nothing. And September held on to its reputation as continuing to be the month that's bad for the equity markets in general. And September 2021 was no different. Greetings, viewers. You're watching Aman Sanga, independent financial advisor in Mississauga, Ontario. For my update for the month of September, I will break it up, as always, into three main components. We will start with the index returns for the month of September. And no surprise here, they have held on to their reputation of being negative for the equity markets. And then we'll try to deconstruct that return, the negative return, and attribute it to some of the main developments that could have caused this being negative for equities. So let's get started with the index returns first. So if you watched this chart from August, you know that the numbers have come down for the major equity markets. The emerging markets, it's basically been flat, and a lot of that has to do with China, and we'll come to that in a little bit. And a related theme is that if you see the bond markets, the losses have inched up, and that's related to the rise of interest rates attributed to inflation fears. Again, a topic that I will be addressing in a bit as we come down to it. So if we look at historically, that is before September 2021, this is what the calendar month returns are, averages are, going back different periods, whether it's since 1950, for the past 20 years or past 10 years. Irrespective of the time frame that you look at, September generally has a negative drawdown or negative returns for the equity markets. However, if you look at the magnitude, it averages at less than 2%. But September 2021 would be remembered for a little bit more brutal drawdown than that, where the S&P 500 was down almost just shy of 5%. Now, the next part of this update is just focused on trying to deconstruct this as to what is causing this, and is it transitory, or it could be a sign of things to come. So let's look at the first factor that dominated the news and dragged equities was the debt troubles that emanated from Evergrande, the big real estate property developer in China, which has about 300 billion of debt, and it's struggling to make the interest payments. And you can see that the chart on this right, on the right, the yields for Evergrande debt have shot up to over 14%. And this is having a negative drawdown impact, not only on the real estate sector, but is having an impact on the other sectors that are likely to get drawn down if there was a contagion related from a default on its debt. So this is the first part of the China problem. And the second problem is the Chinese economy itself seems to be slowing down. Now, last year, 2020, China came out of the pandemic lockdown very strong. But now there seem to be issues cropping up with the supply chain disruptions that have taken place during the pandemic. There are other factors like the cost of production going up because of climate change concerns, and that is leading to a spike in the prices of coal, which is the primary source of electricity generation for China. This in turn is replicating further into manufacturing sector where there are rolling lockdowns, constraining the supply chain even further, which is already jammed up from the backlog that was induced because of COVID. So having all said that, so big story, China is slowing down and it is being the second biggest economy of the world. If China slows down, there will be an impact on the world GDP, and that will be reflected in the equity prices. Now, let me just go to the last part of this story, which is connected with this rising price theme. And I'm coming back closer to home here, both in US and in Canada. And you can see that for both countries, the inflation numbers have been reporting higher than the acceptable band, which is targeted by the central bankers for both the countries. So it's trading higher than that. We know the inflation is here. The big question is whether it's transitory or it's a permanent thing. Now, the lines for CPI, irrespective of how they are measured in US or in Canada, they have shot up from the normal expected trend line. However, I think it's too early to call that is it transitory or permanent. But what I could say is that, just to summarize the whole update, is, and I've shared this before, that COVID has disrupted supply chains. Some processes are going to come back onshore. Manufacturing is going to relook at things and say, is there a better way to do this rather than just being dependent on China? There are climate change factors that are weighing down on how companies do business, which are going to be reflected in the cost of production and ultimately how those equities are discounted. So in summary, I'd like to say that it's the impact of COVID, just the virus itself, is still out there, and how it will reflect in our manufacturing, in our services, and ultimately in the economic markets, it's going to take some time for it to settle out. And it could be probably till the end of 2022, where we have a clearer picture as to how things will settle down. Until that happens, I think it'll continue to be a bumpy ride. Thank you so much for watching. We'll be back again with the update for the month of October. Bye for now.